Hi, my name is Chris Laurie, and I'm the Senior Portfolio Manager here at Fiera Capital for the Tactical Bond product. Here at Fiera Capital, we manage about $2 billion for this particular product. I work closely with my associate here, Derek Brown. What I'd first like to talk about is our long-only or traditional bond product and the process we go through to manage that, which will also apply to the other products we do. Let's first go over the investment summary of how we do this product. It's a very active top-down product, the way to look at the bond market. Bond markets do trend, and we want to be correctly positioned in this trend, but we can be contrarian at times, both at the beginning or end of a trend. Style-wise, we do make, in this long-only product, large duration calls, plus or minus 3 years. We do have very conservative credit exposure, even though we can have 45% corporates. And short-term trading, which is a little bit different, adds significant value. Our objective, to add at least 100 basis points a year. Let's look at an overview of the process. What we first like to do is identify the key factors that the bond market is focusing on. We want to determine our outlook for these factors. And what makes us a bit different is we compare our outlook to what's already discounted in the market. Trend analysis is constantly employed, and then we can construct a portfolio. Interest rate anticipation and yield curve positioning are first looked at. Sector allocation, or the amount of corporates or provincials we're going to have, are next done. Then security selection within these sectors. Once the portfolio is constructed, short-term trading will be actively done once the portfolio is constructed. Okay, the first step we look at, identify the key factors. At any one time, the bond market is reacting to 2 or 3 key macroeconomic factors, such as economic growth, inflation, or monetary policy. We try to identify these factors and the relationships between them because they do determine the direction of bond prices. Second step is determine our outlook for these factors. Once the factors have been identified, we want to determine our outlook for these factors. Do we think economic growth is improving? Do we think inflation is going to be a problem down the line? What is monetary policy going to be like? The outlook is determined by in-house and external economic analysis and by discussions with the Asset Mix Committee, the fixed income teams, including our credit analyst. Step 3, we want to compare our outlook to what's already discounted in the markets. It's all well and good to identify and analyze these key factors, but we must also see what's already discounted in the market. There is limited return potential if our anticipations are shared by the market and the consensus are already discounted in market prices. If we think the economy will slow and we're bullish on bonds, but everyone else shares that same view, then there's limited potential return. There's much higher potential returns if our views differ from that of the market. We use qualitative tools such as valuations, sentiment surveys, forecast data, and also qualitative tools. We have ongoing discussions with market participations. Derek and I do all our own trading, so we're constantly talking with traders, salespeople, and other internal and external portfolio managers. Let's talk a little bit about trend analysis. Bond markets do trend for extended periods of time. Not only interest rate, but yield curve shifts and credit spreads increase or decrease. We want to identify these trends and correctly position ourselves within the trends. We never want to fight a trend. Our strategy can be contrarian at the beginning or end of a trend. At the beginning of a trend, few are positioned correctly. Near the end of the trend, a lot of people are piling into that trend, and hopefully we are moving out of that trend. Portfolio construction. First thing we want to do is interest rate anticipation. Again, we have an active duration management, plus or minus 3 years. Our long-term duration call is based on a 3 to 12 month time horizon. Yield curve positioning is what we want to do next. Yield curve positioning is based on our opinion of the future shape of the yield curve. And the biggest thing for that is the analysis of monetary policy. Sector allocation. Are we going to be 100% government of Canada bonds, or are we going to have higher yielding provincial and corporate bonds. It's really a top-down call based on fundamental analysis and historical spread analysis. We like to look at key credit factors. For our sector credit factors, we look at things such as business cycle, competition, or changes in the regulatory environment. Issue credit factors could be such things as balance sheet strength, cash flow, or issue covenants. We next want to look at security selection. We have a very conservative approach. Our philosophy is one of risk avoidance, and our guiding principle is term magnifies credit risk. We only take very conservative positions in the long end of the bond market, utilities and infrastructure, which are recession resistant and have positive cash flows, consistent cash flows. In the mid part of the curve, we will look at the big banks and insurance companies, and only in the short end of the bond market will we look at things that might be a little less liquid, asset-backed securities, or some cyclical bonds. Things that if things go rough, we can retire them, or they're much easier to sell. Our emphasis is on quality liquid issues. We add value by overweighting sectors at the correct time or underweighting. We're not about picking individual securities, looking for a BBB bond that we think might become single A. That's not what we do. And all our securities are approved by our credit team. Because of this, we've had no losses or due to bankruptcies or credit deterioration in the last 25 years. I'm going to talk a little bit about short-term trading, and these are short to medium-term trades, anywhere from 1 day to up to 3 months. And they are based mostly on short-term technical analysis, things like daily sentiment index, trend lines, Elliott wave oscillators, and occasionally on fundamental information. We have a policy of strong risk management. These trades are only done with benchmark Government of Canada bonds, and we use stop losses systematically. Whenever we put on a trade, if the upside target is $2 or $3, there'll be a strict stop loss at something like $1. If we're knocked out of the trade, we'll regroup and try it again. Expected sources of added value. We make most of our money through interest rate anticipation. 2/3 of our money comes that way. Long-term duration positioning counts for 30%. The short-term trading counts for 35%. Yield curve adds about 20%, and sector and credit adds about 15%. These are long-term averages in any 1 year. Any one of these can be higher or lower, but this is how we see long-term averages. On behalf of the Tactical Fixed Income team and Fiera Capital, thank you very much for watching.